Greetings, my name is Joe Bellavia. I'm an adjunct instructor at San Diego Mesa College, and tonight we're going to review Chapter 3 of the 2015 edition of Income Tax Fundamentals by Wittenberg. 2015 Income Tax Fundamentals, Chapter 3. Now we'll cover Learning Objective 3.1, complete a basic Schedule C, profit or loss from business. You may recall that individuals are taxable entities. When an individual owns and operates a business as a sole proprietor, he or she will include a Schedule C as part of his Form 1040. Look over these following slides. So gross receipts or sales were $35,000, less expenses of $8,650 gives a net profit or loss of $26,350. This shows up on Schedule C. Here you see the exact same numbers in our example, only they're on the Schedule C. All right, now we're looking at the top half of Schedule C. Pay particular attention to the questions. Here we note that it's a cash method of accounting, that he materially participated. We're going to talk about those two items in later chapters. It's a first-time business, and did he make any payments that require him to file Form 1099? We answer that question affirmatively. He paid rent, and usually your landlord will need. All right, now we're looking at the bottom half of Schedule C. And it shows the expenses. There you'll see rent, $1,100. That's what I was talking about, the 1099. Generally, a landlord will receive a 1099. And if you go down to line 31, that's his net profit or loss from Schedule C. And that gets carried over to page 1 of the Form 1040. Question, are these deductions for AGI or from AGI? The net profit from the Schedule C is reported on line 12 of page 1 of Form 1040. Yes, good job. The taxpayer was allowed an $8,650 deduction for adjusted gross income. We subtracted the deductions from the $35,000 and then we carried the net amount over to page 1, which is above the adjusted gross income line. All right, the term trade or business, you're going to hear that throughout the course. Trade or business refers to your profession or your trade. You're an accountant or you're a photographer or possibly you're a retailer. If you're an employee, you are in the trade or business of being an employee. Code Section 162 defines the rules for claiming trade or business expenses. They must be ordinary and necessary. That means not extraordinary. Necessary is appropriate or helpful. They have to be reasonable. Traveling expenses are allowed. Okay? A deduction is allowed under Section 162 if it meets 4 critical requirements. The expense must be related to carrying on the trade or business. The expense must be ordinary and necessary. It's ordinary if it's normally incurred in the taxpayer's type of business. It's necessary if it's appropriate or helpful. The expense must be reasonable. The expense must be paid or incurred during the taxable year. All right, for example, rent, accounting, car and truck expenses, legal expenses are all good examples of ordinary and necessary expenses. What if your business is sued for fraudulent acts and you are forced to pay the judgment? Is this considered an ordinary and necessary cost of doing business? And yes, that has been considered ordinary and necessary too. In an inflationary period, LIFO will generally result in a higher cost of goods sold, therefore a lower profit. During an inflationary period, FIFO will generally result in a lower cost of goods sold and a higher profit. Here we have two identical businesses with the same beginning inventory, the same purchases, but we end up with a different cost of goods sold. And the reason is it's how we value the ending inventory. Under the LIFO method, the ending inventory of 10 units assumes that the original $1 units remain in inventory. Under the FIFO method, the system assumes that the 10 remaining units are the most recently purchased one. The net effect of all this is to change the cost of goods sold. This is a continuation of the same example. And here you see that if LIFO and FIFO affect the cost of goods sold, they will also have an effect on gross profit. Here, the LIFO method ended up with a smaller gross profit and therefore less tax. The key to deducting transportation cost is knowing which mileage is deductible and which mileage is not deductible. If you're audited for car and truck expenses, which they always audit, you're going to have a mileage log. And that mileage log will be based upon recording your deductible mileage. Non-deductible mileage is commuting, going from home to work every day, not deductible. It's non-deductible commuting. Transportation costs incurred going between your residence and work locations outside your metropolitan area. Let's say you normally work in a metropolitan area, some area. And occasionally, you might be an electrician and you have to go outside of that area. That commuting would be deductible. When you have a regular place of business, a place where you get up and you drive to every day, you have a regular place of business. Occasionally, you may have to go to a temporary work location. I use the example of a Nordstrom buyer a purchasing agent, works downtown San Diego, goes there every day, but occasionally she might have to go to the Escondido office, okay, directly from home. In that case, she has a regular place of business and she's going to a temporary location. Mileage is deductible. All right, transportation costs between your residence and other locations when your home is your principal place of business. Okay? You get out of bed in the morning, you get in your car and you drive to some other office. It's all deductible as long as your home is your principal place of business. All right, this is something that trips up a lot of people. They want to deduct all of their car. If you use your car in your job or business and you use it only for business, then you deduct all of it. But if it's part business, part pleasure, we have to prorate it. Let's say you drive 6,000 miles for business, 10,000 total, only 60% of the cost is deductible. We just got done talking about transportation, very narrow. Car and truck expenses, airplane, taxi. Now we talk about travel. And these are the ordinary necessary expenses incurred when you go away from home, far enough that a normal person would require rest. Note, travel expense is defined very broadly. It's the cost of meals, lodging, taxes, laundry, and incidentals while you're away from home overnight. Dry cleaning. Let's say you have to have your clothes dry cleaned while you're away. That is also deductible. General rule for deducting travel expenses. A taxpayer generally can deduct the expenses of travel while away from home in the pursuit of a trade or business. So that means generally the IRS considers away from home where you're far enough away that the normal person would require rest. We all have a home and we all have a tax home. A tax home is the vicinity of the taxpayer's regular or principal place of business. For example, if your home was in San Diego but you worked regularly in Los Angeles would be your tax home. You're a truck driver. You leave your terminal and return to it later the same day. You get an hour off at your turnaround point to eat. Because you are not off to get necessary sleep and the brief time off is not an adequate rest period, you're not traveling away from home. No traveling expenses. Why can we only deduct 50% of the meals and entertainment? I think we all have to eat every day, and the government didn't want to subsidize our basic daily living expenses. Yeah, this is an example of the associated test. You entertain the night or the evening before you have a business discussion. In that case, you'd meet the associated test and you would be able to deduct the entertainment costs. Per diem substantiation is just an alternative to keeping records for travel, meals, lodging, and incidentals. We just claim a flat rate in lieu of or in place of the actual expenses. The IRS provides rules for when we combine business and pleasure. The business portion is deductible, the pleasure portion is not deductible. If it's domestic travel, the transportation cost of getting there is generally deductible. Many years ago, I bought a household full of furniture. Shortly thereafter, I got a letter from Uncle Sam saying, "Greetings, you've been selected." I was drafted. So I gathered up all the furniture, sold it to a friend. We wrote up a loan agreement. I was in Germany, and I was getting my payments regularly. The payments stopped coming. I wrote them a letter, and they said, fine, they'll send me more. Payments stopped coming again. Okay, this was 30 years ago, 35 years ago. There was no internet. There was no following up. Basically, I had a bad debt. As a non-business bad debt, I get a short-term capital loss treatment on my tax return. Home office deductions are interesting. Prior to, I think, 1993, a lot of controversy back and forth with home office deductions. In 1993, it went to the Supreme Court, the Solomon case. He was an anesthesiologist. And an anesthesiologist generally performs his work at the hospital. Well, his home office he used for paperwork, for issuing bills. It went to the Supreme Court. The Supreme Court said the test is where you earn your business, where you earn your money. And so since he earned his money at the hospital, he lost. That pretty much put a kibosh, or put the end to home office deductions. Congress came to our rescue in this case, and they said that taxpayers' home office will qualify as their principal place of business if they use it exclusively and regularly for administrative or management activities. And there is no other fixed location where he conducts business. So basically they're saying if you don't have any other location and you do paperwork at home, you're entitled to the home office deduction. Once you calculate the home office deduction amount, you will find out that it is limited to the amount of net income from the trade or business. So in other words, you cannot create a loss using a home office. Any unused amount will be carried forward indefinitely. And then the IRS came out with a simplified method for calculating the amount. It's basically $5 per square foot up to $1,500. Here are the solutions to Chapter 3. Check your homework. I'll see you next week.